let us open a price chart to get to know exactly what's happening in the market. So now this is a price chart, a daily price chart of Adani Ports. Now if you look at some kind of a price action that is happening here, you would observe that from here to here the market has moved up. Would you agree? Even from here to here the market has moved up. What do you think is the reason why prices moved up like this? Could it be because of some good earnings? Could it be because the order book was really good for this company? Could it be because the overall the industry was doing very well? Yeah, it could be any one or maybe all of these reasons. But there is one reason and only one reason for price to move up from here to here. What do you think is that one reason why price moved up? Exactly, it is demand. When demand exceeds supply, prices move up. That's the only one reason. So that's the reason why sometimes you see prices dropping even when earnings announcements are good. Maybe there isn't enough demand at that time. What do you mean by demand? Buying, exactly. More buyers means more demand. So whenever you see more buying than selling in the market, prices move higher. And that's what we mean by demand. Now see this period over here. During this period, prices dropped. Why do you think prices dropped? Is it that the fundamentals of the company was bad, or was there some bad news, or was there some poor results being declared? Yeah, it could be any one of the reason or all of them. But the only one reason that matters is that there was excess of supply more than demand. That means there was more selling than buying happening during this period. I'm sure you all would agree on that. It's a basic fundamentals of any market. Now look at this period here, maybe for a few days, just 3 or 4 days. What happened? Prices never moved up nor down. It was sideways. Now, why do you think prices did not move down nor up during that period? Demand and supply was at equilibrium. Exactly. There was equal amount of buyers and sellers in the market. So basic reasons for market to move up and down or sideways is only the amount of demand or supply in the market. All other reasons which can be attributed are secondary factors. What is then the best way to determine whether we have demand or we have supply at any point of time, so that we can choose to buy when there is more of demand and we can choose to sell when there is more of supply? Is looking at fundamentals a good idea? Question is which fundamental to look at. There could be earnings announcements around the corner. There could be some news that's coming up, something happening in the industry as a whole, maybe some government regulations that are affecting the business prospects of the company. Yeah, there could be a million such factors that affects the price movement. Is it humanly possible to really assess all these factors and see how much they are going to impact on demand and supply? That's the question to ask yourself. Instead of looking at fundamentals, just by looking at a price chart, isn't it possible to make out whether there is more demand or supply? Simply by seeing an upward movement in price, we can presume there is demand. Simply by seeing a downward movement in price, we can presume there is supply. And simply by seeing a sideways movement in price, we can presume that demand and supply is at equilibrium. So I'm going to show you how you can really look at price charts and determine demand and supply. And I use only demand and supply and price charts to decide whether to buy a stock or to go short or sell a stock. And when I talk about price chart, yeah, we have candlestick charts, we have bar charts, and we have line charts. But then I look at candlestick charts. Why do I look at candlestick charts? One, they are quite visually, visually quite good to look at, and they give you a very clear indication of what's happening in the market. Let's look at one candle at close. Just look at this candle right here. Now a candle has a wick, a body, and another wick. So two wicks and a body. The upper wick, the lower wick, and the body. So the top of the wick is the high. The bottom of the wick, the lower wick, is the low. And this area here where the body starts on the top of the body is the open for the day. And the low of the body is the close for the day. Now, since this is a daily chart, as you can see over here, each candle represents a day. So on this particular day, the high, the low, the open, and the close are represented in this one candle. Let's look at another candle here. Now this one is green in color. The one which we saw earlier was red in color. The reason why this is red in color is because price during this period came down compared to the open. So open is higher and the close is lower. Now in this candle, the high and the low also remains the same. But since it is green in color, this is the open and the top of the body is the close. So during this period, price went higher. So this is a bullish candle, which is green in color. And this is a bearish candle, which is red in color. So how do candles help me? Now, if I see a sustained downtrend, you will see a series of red candles there or a series of bearish candles. So just by looking at a lot of red on my chart, I know that the price has dropped during that period. Whereas if you see in an uptrend, when prices have moved up, you will see more of green candles than red candles. So just by having one look at a chart, I know whether prices have been generally rising or prices have been generally falling. So how can I know by looking at a price chart at what price there is demand and what price there is supply? Let me just show you a trade which I took this week. Reliance Infra. So that was on a 15-minute chart, I think. Yeah, there we have it. So let's look at this chart of Reliance Infra. It's a 15-minute chart. Let me zoom in over here. So we have a period of prices falling, a very short break, and prices rising again. If prices have to stop falling and start rising, isn't it presumed that there is demand around this price level here? Say I'm talking about between 415 and 417. So that's the reason I have marked this area in green to show that I expect at this price level between 415 and 417 we are going to have a lot of demand. This level can also be called as an area of support. Okay. I'm sure you have heard about support and resistance before. So what is support? Basically, support is nothing but a bunch of buy orders. A lot of buying happening at a particular price. So just because a lot of buying happened at this price, prices started moving up. Now the maximum amount of buying in this uptrend, where do you think it happened? Here, here, or here? The maximum amount of buying should have happened here. Why? Because this is the price point where the direction changed from down to up. So you may say that, yeah, there is demand all over this place. But the maximum demand is over here where the price turned direction. We can call this a pivot. We can call this an area of demand. We can call this support, whatever you want to call it. This is a place where there is a lot of demand. So that's why I marked this area in green to show that there is demand at this point. Now, when you join a course with me, I will show you exactly how to determine these price points. But we don't have time to get into that in this video right now. But let's see what happened when price returned to this particular zone or this area of demand. So if you observe here, price tried coming back to this area several times. Once over here, once again over here, and then over here. So every time price came very close to this, it bounced back. Can you observe that? Every time price came near to my area of demand, price really bounced. When price came over here and actually entered this area of demand, that's when I bought the stock. My entry price is here. My stop loss was just below the area of demand, and my target, I kept it around 2 times the risk that I was taking. And as you can see, the price, it came into this area of demand and immediately bounced back and hit my target price, and I was out of the trade. Now when price again came, it came, violated this area of demand. It came below. Why? Because by the time prices came here, a lot of buy orders were filled and there were no more buy orders left. So this is how I identify areas of demand on the price chart by just looking at a candlestick chart. Let's look at one more chart. This is another trade I took this week on Mindtree. Yeah, this is also on a 15-minute chart. Okay, now here I have identified an area of supply, and I've used it to go short on Mindtree. As you can see here, price has moved up slightly, after which it moved in a sideways for a few minutes. Then we see a sharp drop down. Now this sharp drop down gives me an indication that we have supply over here. It's an area where the drop started. So I just mark this area in red. The price between 990 and 998 is an area of supply. Not very long after I mark this area of supply, prices returned back. It entered the area of supply and again fell very sharply. My entry price was at 991.75 to go short. Just above the area of supply, I had my stop loss at 998.25, and I kept 975 as my target. So as you can see, price went up, immediately turned down and sharply fell from the area of supply. So candlestick charts and price charts are very helpful in identifying areas of demand and supply on price charts. And these can be used to identify trading opportunities to go long and short. Many use indicators like moving averages, MACD, stochastics to identify areas of demand and supply on price charts. But I use only price action. I really don't use all those indicators because I feel they are lagging. What do I mean by lagging? They tell you much after the price has turned. For example, if the price is in a downtrend, then it turns to an uptrend, and then again if it has to turn to a downtrend, if it has to give me a sell signal here, by the time it gives me a sell signal, the price would have already reached halfway down. So using indicators is something which I don't prefer to do, because I get information very late as to when prices may turn the direction. So instead of using indicators, it's good to train your eyes to see demand and supply just on candlesticks and on price charts. So the method which I use for trading is basically a method which is based on price action and not on any indicators. And if we go by what an indicator is, an indicator is nothing but a mathematical calculation from price. So automatically, since the calculation is coming from price, isn't it better to look at price and then take a decision, or to look at an indicator and take a decision? So let us now look at the chart of Nifty and try to find out if we are having demand or supply at the current price levels. So this is a daily chart of the Nifty. So markets have moved higher the last 2 days. So as you can see here, Nifty has moved higher. It has paused for a day or two, and then we have seen a sharp fall in the Nifty. So I'm going to just mark this area as an area of supply, or we can call it even as resistance. So today prices entered this area of supply and slightly reacted from there. So we can probably expect Nifty to move lower in the next couple of days, next couple of trading sessions. Why? Because we are near to areas of supply. So when you join a course with me, I shall give you more details on how you can actually get to know exactly where is the area of demand and supply.